The Federal Reserve's monetary policy decisions are a linchpin of global financial markets, influencing everything from stock prices to borrowing costs. As of May 11, 2025, the Fed's recent decision to hold interest rates steady at 4.25% minus 4.50% has captured the attention of investors, economists, and policymakers alike. This move comes against a backdrop of heightened economic uncertainty, driven largely by President Donald Trump's aggressive tariff policies and their ripple effects on inflation, unemployment, and economic growth. The Fed's cautious approach signals a pivotal moment for the U.S. economy as it grapples with the specter of stagflation and a potential recession. This article delves into the latest developments surrounding the Fed's stance, analyzes the underlying economic dynamics, and explores the implications for investors and the broader economy. Latest developments. On May 7, 2025, the Federal Reserve announced it would maintain its benchmark interest rate range, a decision widely anticipated by markets, but accompanied by a sobering warning. The risks of both higher inflation and unemployment have risen significantly. The Fed's policy statement highlighted increased uncertainty in the economic outlook, a nod to the disruptive impact of Trump's tariff proposals, including a 145% duty on Chinese imports. While the central bank avoided directly naming tariffs, it referenced volatile trade activity affecting key economic data, such as the negative gross domestic product (GDP) figure, reported for the first quarter of 2025. The Fed's statement was followed by a press conference from Chair Jerome Powell, who used the word uncertainty 13 times in 45 minutes, underscoring the challenges of policymaking in the current environment. Powell emphasized a wait-and-see approach, noting that businesses, market participants, and forecasters are all awaiting clarity on how trade policies will evolve. Market reactions were mixed. The Dow Jones Industrial Average rose nearly 300 points after the announcement, recovering from initial losses, though concerns lingered about the Fed's characterization of economic risks. Elsewhere, trade negotiations have added to the complexity. On May 10, 2025, senior U.S. and Chinese negotiators resumed talks in Geneva to de-escalate their trade war, with Trump describing the discussions as very good. These talks follow a turbulent period for markets, including a significant sell-off after Trump's April 2nd Liberation Day tariff announcement. Recent indications of progress in negotiations have helped stabilize markets, but the outcome remains uncertain. Analysis. The Federal Reserve's decision to hold rates steady reflects a delicate balancing act. Inflation remains somewhat elevated above the Fed's 2% target, while economic activity has expanded at a, quote, decent pace and labor market conditions remain solid. However, the central bank's acknowledgement of rising risks to both inflation and unemployment points to the growing threat of stagflation, a scenario where high inflation coincides with slowing growth or recessionary pressures. Recent economic data paints a mixed picture. The negative GDP growth reported for Q1 2025 signals a slowdown, potentially exacerbated by trade disruptions. The SOM rule, a real-time recession indicator, has not yet been triggered, but economists warn that a downturn may not be officially declared for months due to the National Bureau of Economic Research's reliance on retrospective data. Meanwhile, inflation pressures persist, driven by supply chain dislocations and higher import costs from tariffs. Thomas Simons, chief U.S. economist at Jefferies, argued that the Fed's language understates the extent of disruption since its March meeting, describing the outlook as unpredictable. Market expectations for rate cuts have also shifted. According to the CME Group's FedWatch tool, the probability of a rate cut in May was just 3%, with less than 30% odds for June. Traders now anticipate the next cut in July, with total 2025 rate reductions revised down to 2.68 from 3.19 a week earlier. This recalibration reflects optimism about potential trade deals, which could ease inflationary pressures, but also acknowledges the Fed's cautious stance amid tariff-related uncertainty. Expert opinions highlight the complexity of the situation. PIMCO's investment chief, Dan Ivison, told the Financial Times that a recession is a real possibility, though he expects tariff rates to moderate over time. PIMCO has increased its exposure to U.S. government debt with shorter maturities, citing rising market volatility and a worsening fiscal outlook. Similarly, Morningstar's U.S. economics team projects slowing real economic growth throughout 2025, with trade disruptions likely to amplify this trend. They recommend investors overweight value and core stocks in defensive sectors to hedge against near-term turbulence. Financial markets have shown resilience, with the S&P 500 up 17% from its April 7th low, driven by optimism about trade negotiations. However, technical analysis suggests stocks are approaching resistance levels, and a failure to secure positive trade outcomes could trigger a sell-off. Gold prices, a barometer of economic uncertainty, jumped over 2% in early May, with bulls targeting a retest of the $3,500.20 record high, supported by a weakening dollar and dovish Fed expectations. Corporate earnings also reflect the broader uncertainty. Amdocs Limited, a technology services provider, reported on May 8th that its 12-month backlog represents 90% of forward-looking revenue, but its 2025 guidance accounts for macroeconomic and geopolitical risks, including tariffs. Symbotic Inc., a robotics company, noted that tariffs are not factored into its current guidance, posing a risk to future margins. These examples underscore how businesses are bracing for potential disruptions. Future outlook. The Federal Reserve's path forward hinges on several key variables. First, the outcome of U.S.-China trade talks will be critical. A de-escalation could alleviate inflationary pressures and support market confidence, potentially allowing the Fed to consider rate cuts in mid-2025. Conversely, entrenched tariff policies could exacerbate inflation and weaken growth, forcing the Fed to maintain or even raise rates, risking a deeper slowdown. Upcoming economic data will also shape the Fed's decisions. The Consumer Price Index, CPI, and Producer Price Index, PPI reports, due next week, will provide fresh insights into inflation trends. Retail sales data will offer a gauge of consumer spending, a key driver of economic activity. If inflation remains stubborn or unemployment rises sharply, the Fed may face pressure to act, though Powell's comments suggest a high bar for policy shifts before June. Globally, trade tensions are influencing other central banks. The Bank of Japan's cautious stance and China's planned briefing on market stabilization measures signal a coordinated effort to mitigate tariff impacts. These developments could affect currency markets, with the USD-JPY pair potentially testing 150 if U.S. economic data surprises to the upside. For investors, positioning will be crucial. Morningstar's advice to favor value stocks and defensive sectors aligns with the need to navigate near-term volatility. Savers may benefit from elevated savings account rates, as the Fed's pause keeps yields on savings accounts and CDs propped up. However, borrowers face challenges as high rates continue to constrain access to credit. Conclusion. The Federal Reserve's decision to hold interest rates steady on May 7, 2025, reflects a prudent response to an increasingly uncertain economic landscape. With Trump's tariffs driving fears of stagflation and a potential recession, the Fed is adopting a wait-and-see approach, prioritizing data clarity over premature action. While markets have shown resilience, bolstered by hopes of trade de-escalation, risks remain elevated, as evidenced by the Fed's warnings and cautious corporate guidance. Looking ahead, the interplay of trade negotiations, inflation trends, and economic indicators will dictate the Fed's next moves and the broader market trajectory. For investors, a defensive stance and close monitoring of upcoming data will be essential to navigate this turbulent period. The Fed's steady hand may provide stability for now, but the economic horizon remains cloudy, demanding vigilance and adaptability.